Hey everyone, it's Norm Farrar, aka the Beard Guy here, and welcome to another Lunch with Norm, the Amazon FBA and e-commerce podcast. Today, we're going to be talking about what you can do to get premium exit valuation for tomorrow. The episode is also going to be talking about the ever-changing landscape for these exits. Also, 5 specific actions that you can take today to maximize your valuation. And our guest is also going to share his core 4 pillars that determine your valuation. It's going to be awesome. If you haven't heard, or if you've heard, let's say, people talking about exiting, stay tuned because this is a really different way of learning. Okay, so Hayden, hit the music.
Lunch with Norm.
Okay, so like I mentioned, today we're going to be talking about what you can do today to get premium exit valuation tomorrow. Our guest, I can't believe it's the first time he's been on the podcast. He's one of my very good friends. He's founder and CEO of Northbound Group and helps people sell their businesses. And after selling his first business for a measly 8 figures, he discovered a passion for helping other entrepreneurs get their maximum valuation for their company. He's raised over $25 million in capital for himself and for clients up to date. I always screw up once in a while. You know, every podcast, there's at least 10. But today, my very special guest and friend, Scott Deetz, will be joining us. But first, let's have a word from our sponsor. As you know, at Lunch with Norm, bigger is always better. Bigger business, bigger profits, and yes, bigger lunches. Z wants to make sure that your business and profits are bigger by taking you and your business international. They are a one-stop importer of record shop, including compliance and logistics services. They focus on all the elements involved in a smooth first-time custom clearance so that you can focus on what you're good at, selling. Click on the screen now or follow the link in the description box below and get 50% off your first shipment today. Where is my other boy wonder? You just gonna...
Hola. Guess who's back?
Yes, he's back. Oh my gosh. So we had a bit of a problem today. Kelsey, I can't believe this is happening. Kelsey wanted to go to his first big event and, do live wheels of Kelsey, catch up with Cassandra, hang around with Tim, do the whole Vegas thing. He tested positive for COVID. So anyway, that really sucks.
Personally, I think that's a sign.
What's that?
Personally, I think that's a sign.
So I have my other son, Hayden, the producer of The People, fill in. So Hayden, what do you have to say?
Not too much. Welcome, everyone.
You got to do a better job than that. You're supposed to smash those like buttons. Come on now.
Okay, let me see my notes. Let's see. You have to smash that like button.
Ring the bell.
Ring the bell.
God. You're going to be so fired. You're going to be turfed.
Follow, like and follow. Is that what that says? Like and follow the podcast wherever you get your podcasts.
I thought Kelsey was bad.
All right. Nation knows the drill.
All right. Beard Nation does know the drill. Okay. So today, if you have comments, if you have questions, throw them over in the comment box. This is going to be a really great episode. Like I said, Scott delivers. It's just a different way of looking at things. And I think you're going to really like it. So anyways, if you've got friends, if you've got some family that are in Amazon or involved with e-commerce, make sure you get them over to the podcast today. It's going to be great. And yes, Simon, yeah, hashtag Wheel of Kelsey or hashtag Wheel of Hayden. That will be happening today.
That's right.
Okay, so sit back, relax, and enjoy the episode. Welcome, Mr. Deetz.
Hey, everybody.
Hey, how are you?
Great, Norm. How about yourself?
I am doing fine, thank you. Scott, I mean, you're one of my favorite people. And one of the things, this is really cool. This is what I like about networking. So just the last time we got together, I'm sitting there and there's a whole group of us having cigars. And we just kind of, this was really late at night. I don't know what time it was, but we kind of just started talking, and you started talking about these speakers that you brought, and you had this music, and I don't know, I mean, it was crazy amount that you spent on these speakers, and these speakers were huge, but you travel around with these bloody speakers. You probably have them right there. And we went up to your room. I don't know if it was 2:30 in the evening, and you were cranking the music. And oh my gosh, it was just a great experience. I got to tell you, it's one of the things I'm always going to remember about these events.
Awesome, bud. Yeah, I tell you, it was so much fun for me too. So yeah, the speaker system. I have a passion for music. My whole family does, and I wanted to have a sound system that sounded as good or better than any home theater system, but would still fit in a carry-on. So after searching the globe over with some of my audiophile friends, I was able to find it, and then it's great just to share it with another music lover. So I remember we went through some of the old classics, everything, rock and roll and classic rock, and it was just great to sit in a room and hear beautiful music.
Yeah, and just I mean, and it was, man, I'm an old guy, and I was just sitting there. I could have gone all night with that, but hey, are you going to Vegas or Prosper?
Yes, absolutely. Yep, getting in Sunday, leaving Thursday.
That's the same with me. So that's great. We'll be able to meet up again. Okay. Like I said at the beginning, you have a really great way of just delivering this information. It's, when we were talking, this is going back to the first time I met at Accelerator. We just started talking about business plans, exits, and you just got a great way of talking about it. So I want to, like, just to talk to everybody that's listening right now that's an Amazon seller, probably have some plans on exiting. And some people start their Amazon journey thinking that they're just going to sell a few things, and they end up, wow, this is really a business. And so what do you do to plan that valuation? And I think that's where we should start. How is the landscape changed right now for Amazon sellers?
Yeah, and so a couple of things. The first place I always start, for anybody who's on the podcast, is with the mindset of the time that you should start planning for your exit is when you get into your business. So if you're already in business and you are a seller, e-commerce seller, you should already be planning your exit, because a lot of people tend to think of it as, I build a company for a whole long time and then I think about my exit. And a lot of that is, I come from the Midwest in the United States, so Wisconsin. You plant in the spring and you harvest in the fall. So you need to start thinking about laying the seeds and the groundwork for getting your exit, literally from the first products that you design. And there's two main reasons for that. One of them is, and we run this a workbook chart with every one of our people that we work with, and what you'll find is, for the average physical goods business, more than half of the money you ever going to take out of your company comes on the day you exit, not the entire time that you're running it. So, Norm has an e-commerce business. You're running it for 3 or 4 years. You're not taking a lot of money out because you're always buying more inventory, more stock. And then if I told you that if you were ever going to make $1 million out of running this company, that more than $500,000 of that is going to come on the last day when you do the last thing right and you exit it, you'd actually think about that business differently. but because most people maybe aren't aware of that fact, they're just running the company, and then at the end they're hoping that it deserves an exit, but they haven't been strategically planning for it. So if you take nothing away, folks around this, and we've got if you stay on here, Norm can talk about it, but we've got a template of all the things that I talk about. I want to give you a tool that shows it to you, but really understand that the bulk of your money comes when you exit your business, and there's a specific strategy that you can do to get a premium valuation. So I always start with that because it might seem obvious once you know it, but for a lot of people, they kind of thought that only certain people get to exit companies. And the great thing about this industry is virtually any business can get an exit as long as you're profitable.
So going back a few years ago, let's say 2016, 2017, when you talk premium valuation, that would probably be around the 2 mark, right? Probably 2.5, and you're doing the happy dance. Right now, what do you think the average valuation is?
Yeah, and so the way that I would describe it, what's happened from I'll call that the early days of exits, when a 2.5 or a 3 multiple was considered a premium exit. And just to clarify, I'm talking about the multiple of your trailing 12 months profit, and that can get defined multiple ways, but that's what we're talking about when we use the multiple. I'm going to refer to that as what's called the entrance multiple, because that's what you originally signed the deal at. And we look at something that's called lifetime effective multiple. And the reason why we look at that is because the next mindset change I want people to think about is that it's not what you signed the original piece of paper on. So let's just say right now that a premium multiple would be something a 5x multiple or a 6x multiple. So if you're making $500,000 and you sign for a 5x multiple, that's $2.5 million. But depending now, what's changed in the last 12 to 24 months with all of the buyers getting smarter out there is they've put more contingencies on you actually achieving that 5 times multiple. So they'll say it's a 5 times multiple, but you'll only get 3 times up front. And then the second 2 times multiple will only come if you grow at 20% per year. Well, the next buyer over might be offering a 4.75 times multiple, but you get that extra above the 3x if you just stay stable. It's called a stabilization payment. So it's absolutely critical that you look at not just what I'll call it the headline multiple is, but you look at what I call your guaranteed multiple, which is your cash at closing, and if there's any seller financing. And then you look at your lifetime effective multiple against your growth rate of what you think the business can do with that particular buyer. So on one hand, people say, Scott, you're making it a little bit more complex than just the simple number. But the fact of the matter is nowadays is that if you don't have confidence that a buyer can take over your brand and continue to grow it, that 5x multiple that you thought was a good multiple, if you don't hit those stabilization payments, will get backtracked down to a much lower multiple that you would feel unhappy with. So, I threw out a number of different terms there. I want to make sure, Norm, that you understand it, but I think it's very critical that when we're talking about multiples nowadays, we can't just use that top line number, because there's so many contingencies that are layered into what makes up that particular number. It's a lot like if I know what your revenue is, do I know how profitable you are? And the answer is that you don't. So really focus on understanding the multiple in its entirety, not just what the headline number is.
So I work with sellers. I also have my own brand. And one of the things that we've built, because Amazon's asking us for this right now, is to build your brand community. Well, the perceived value, the marketing, all the costs and expenses that go into it, you don't see the profit. You might lose. Like, I've got a brand right now, it's losing, but my goal over the next couple of years is to grow the brand where it's well known, and it won't fit in to that valuation. But where it will fit in, and I don't know if any aggregator will even look at it, private equity would, but it's it's showing that the brand is there, showing that you have market share, and then getting sales, like one-time sales. So if you've got $10 million company, you get $10 million instead of doing the traditional form of valuation, which most people talk about, which is what we were just talking about. Have you seen a shift at all going down that path, like putting money into your brand? Like right now, I have a brand that's not making money, and it's not planned to make money, and that's part of the strategy. I
Mhm.
mean, maybe I'm a sucker. I don't know, but
Yeah, yeah. So I think two things. One, at Northbound, and I speak from, we've done hundreds of millions of dollars now in helping people exit their companies, and about 80% of what we do is what I would call the physical goods side of the business, and about 20% of what we do is service companies, tech-enabled service or SaaS companies. And so I'll speak to that, both of them, because on the service side or on the SaaS side of things, the multiples will sometimes be based on revenue and or what's called contribution margin. It'll go up the profit and loss and be more of a revenue based valuation. Very rarely for an Amazon company are you going to see a valuation based on revenue. It's almost always going to be on contribution margin or on EBITDA or seller's
right,
discretionary earnings. If you have a hot brand that is omni-channel, that is direct to consumer, it might be wholesale, retail, and it's really a rocket ship of growth. The way that I would describe it is that rather than trading on revenue, like what maybe you suggested, there'll be an accommodation made where the profit might be lower, but because the growth rate is so high and the audience is being built in such a way, you'll get what's called a strategic buyer to come in and offer a premium above what the financial valuation is. But I think it would be, in general, the way that I would plan it is that that brand should eventually lead to profitability, and you should plan your exit for right at the time that it's leading to profitability. So for example, you're going to run this company for 2 to 3 years. It's going to be very low profit. You're going to be building your audience. You're going to be launching a lot of different products. You're really establishing that particular brand. Before you go to exit, you should be able to then show what the value of that brand actually eventually translates into economics, into profitability before you exit, because then you will have proven two things. You'll have proven brand, and you'll have proven a quantification of what the value of that brand is. And the reason I recommend that is because the more you ask a buyer to have to prove out, the more the price goes down. So, they like to basically insert more money in the car to make the car go faster. They don't want to have to actually figure out, how do I monetize this brand? So I would focus most of the people on this podcast toward, it's okay to have some high growth moments, and that might come at the expense of profitability short term. But when you get that year before you exit, you should probably look to turning it to profitability, or you should, in order to get the true premium value of the brand.
right. Great advice. Okay, going back to how the landscape has changed right now, I just want to talk about why over the last year, and it'll probably change next year, but why over the last year and a half has it gone berserk?
Yeah. So I think it's gone berserk, and I think also a cautionary tale is that we might be at the coming toward the end of berserk times.
Yeah,
And so
I agree. Yeah.
uh, um, there's really been three or four macro factors that have been driving valuations, and now are making it more difficult for buyers or aggregators to price a deal, to know what they should pay for a deal. You've got the combination of huge tailwinds from the macroeconomic environment. Very low interest rates, so money is dirt cheap for the buyers. And when buyers don't have to pay much to finance deals, they can afford to pay you more. You had the COVID lift of e-commerce overall, and even if you're not individually, you might go up or down depending on whether or not you were in PPE or you were in travel. You might have had your own COVID impacts, but what you've got going on is, in general, e-commerce accelerated. um, the aggregator model is based a lot on a multiple arbitrage, where the valuations that they're receiving, is on a different size than what they're paying. So there was a spread between them, and that they could afford to pay more because they still had a spread between their valuation and your valuation. And then you had the final factor is that you had a lot of shipping and logistics things, that hit in this last year, so that if I'm a buyer, I'm trying to price a deal, but I don't know if whether or not I can get the goods. I don't know how expensive it's going to get them. And so different people have looked at, those valuations differently. The way that I would describe where we're at right now is that the premium valuations are still definitely out there, but getting a closed deal is as hard or harder than it's ever been before. And so what I mean by that is you can still get one, we've just got a transaction that just recently closed. It was a little over a 6x multiple, maybe 6.4, which many people would say is quite a nice multiple. But the due diligence of being able to get that deal over the line is much harder than what it was, for a couple of reasons. One, because of all of the logistics and PPC costs and those things going up. But secondly, you have a market that's maturing in terms of buyers. They have bought a lot of things, and some of them haven't worked out. And so every time you're an aggregator and you buy something that doesn't work out the way you want, you go, okay. My brother always used to say, experience is what you get when you didn't get what you wanted. And so,
Right.
they're getting more experience and they're learning. And so every time you have something that doesn't go well, you add that to the checklist, that you're going to make sure that the next thing you buy, doesn't have that particular issue. And so the diligence checklists are getting longer and longer. And so it's more importantly for you to have a tight or a clean company to try and get that premium valuation than what it was in the heydays, maybe a couple years ago, when people were just buying things to grab scale.
Okay, so just a few things. If you have, or if you're going to be exiting soon, I saw a comment from Simon saying that he was planning on exiting fairly soon. But if you are, and if you have any questions, please throw them into the comment section. And if you've had any nightmares exiting, what would you like? Could you please put them into the comment section as well? We'd like to see, some of the problems that you might have had. Okay, now let's talk about the Wheel of Hayden. We do have a giveaway today, Scott. Do you want to just describe it for a second?
Yeah. So anybody that's on the podcast, I've been leading something called a corporate development mastery program for a number of years, and in essence, what it does is, and this is very relevant to exits. We don't only help people with exits, but what we really started out doing was helping people with strategic finance and really understanding your numbers. A lot of people maybe understand their accounting, but they don't understand, how much capital I need to grow. How do I do forecasting? A number of people, are struggling there. Other people struggle with things like my college buddy and I got into a 50-50 partnership, and one of us wants to exit, and the other one doesn't. How do I do a buyout of my partner? Or conversely, how do I bring in a partner? I call it my rich Uncle Bob problem, where my rich Uncle Bob wants to put $100,000 to say he's in the Amazon game. And how do I structure taking that money in so that I can accelerate my growth? And so what the result of that has been over the last year and a half or 2 years is a workbook that has templates for how to understand all of the different ways that you can value your company, the way that you can understand what drives that valuation. And so for anybody that's on here that's interested in that, I'm happy to give that away, at no charge. And it'll give you a great resource of, if I wanted to, for example, do a minority exit of a partner, how do those things typically get structured? Or if I want to run a valuation of my company and I want to keep a valuation every month and update not just what my accounting numbers are, but what my company is worth, there's a template in there for people to do that as well. And we found that it's very, very helpful. And then I think we were going to have one person also that was going to get something extra. Should I go through that as well?
Yeah, please do.
Yep. So for one person, and I'll leave it to the people with the beards to determine how all of that works. I'm happy to sit down with someone over Zoom for half an hour, and I'll give you. I've been in this a long time, as you can tell by the color of my hair. I started my first exit was now 19 years ago, and have been helping people kind of ever since. So. Happy to give you an assessment. How do you stand up against the 4 pillars of valuation that you need to be thinking about? What would you need to change now today if you wanted to get a premium valuation? And how do you, and what are buyers going to probably hit you on? And then walk you through one of the sheets to show you what your valuation of your company would be today. And more importantly, what's the valuation of your company going to be when you get ready to exit? So
All right.
happy to offer that.
That is fantastic. So everybody will receive, as long as you follow the link, that workbook, as well as you can enter just hashtag yes Wheel of Hayden or Wheel of Kelsey. Tag 2 people, you get an extra entry. Also, Hayden, I know you're new to this. You can put your finger on the button and hit the sponsor, maybe, or a big thank you to our sponsor, Startup Club, the largest club on Clubhouse with over 790,000 members and growing. They're one of the world's largest communities supporting the startup ecosystem, from founders to those wishing to work for a startup and everything in between. You can find them at www.startup.club for blogs, recordings, and a calendar of upcoming shows, and on the Clubhouse app. Just search Startup Club for daily shows 24/7. You can also now listen to their show, the Serial Entrepreneur Club podcast, on Apple and Spotify too. Stop by to connect, learn, and grow together. All right. So Hayden, I don't know. I know we haven't done this before when you were doing this, but if the questions, I don't know if you can separate the questions and put them into a separate area and we can get them later. Okay. I don't know how Kelsey does it. I just talk. So, so anyways, let's get right into these actions, these 5 specific actions that you should take to maximize valuations.
Yeah, perfect. So the first one that I start with is not where most people think. Oh, you're going to start with profitability or grow faster, all of those types of things. Where I actually start and we coach all of the clients that we work with is, what's your exciting story? So the first specific action that you should take is to draft what is the exciting story of your business that would get a buyer excited. And my mentor has done over $20 billion in transactions, and yes, that is a B. And he always said to me, Scott, he says the number one thing is to always remember it's not what the seller is selling, it's what the buyer is buying. And so, what I want everybody here that's on the podcast to do is to get out of thinking about yourself and think about your buyer. Let's say it's an aggregator, or it's a private equity company, or it's a strategic buyer. What do they believe that they're actually buying? And what's the exciting story of what they're buying? And I'll give you an example of one that's not. Many people go to look to exit their business, and I ask them, why are you exiting your business? And here's what they tell me. I'm working 100 hours a week. I'm not making any money. I can't get my launches fixed. I'm getting tired. I'm getting exhausted. I've had Chinese competitors come in and lower my margins. I haven't been able to get out any new products, and I can't find any team members. So I think that I'd want to sell. So my
Great
answer is,
reason.
yeah, it is a good reason. My answer though is that and I'm glad when we first start working with people, it's like, give us all of that. You can't help if you don't know what's wrong. But what you really found yourself in is that through a series of decisions, you ended up in a business that is not very exciting for you to run, which probably means it's not going to be very exciting for a buyer to buy, because there's fundamentally things that are going on in the business. And the interesting thing about it is, if we think about what an exciting story is, the way that I try and coach people is, Just think of it what you do every day when you put up a product listing. When you put up a product listing, your first product listing, when you ran your business, you're probably the same as mine. The first listing you put up was all of the reasons why you thought that people should buy the product. And it was very feature oriented. It wasn't very benefit oriented, and it didn't appeal to them emotionally. And everybody buys, we know this, everybody buys emotionally and justifies rationally. It's the exact same thing with your buyer. So just think of your buyer as your ultimate customer and put their hat on. And the first thing that you want to think about is what makes for an exciting story. And I'll give you a couple examples of those. One of them would be, for example, I might not be growing that fast, but I have 35% contribution margins and a 30% profitability. So I've got a really great moat in a very small niche with relatively low competition. For a lot of buyers, boring is beautiful. And they'd say, you mean you've tucked out this corner of the world and you get, $500,000 of EBITDA and it's growing at 20% a year, but you've got 30% margins and nobody wants to come in there because, people have, built up what your review moat is, and you've built up this niche. Somebody else might have a different story that says, you know what, I've only got 15 to 20% margins, but I'm a high growth and I have figured out how to add variations. I get in on a product and then I add a bunch of variations, then I go to my next product. So the point is that the action item that I'd want everybody to take is on one sheet of paper or less to document the bullet points of what makes their story exciting. And if you can't get to, a half a page or a page because it's not that exciting, what you then need to do is write down what you would want the story to be. And then that gives you the gap between where you are today and where you should be going forward by the time that you look to exit. And so it's a very useful exercise, and most people skip over it and kind of get to the tactical. And what I always say is the first thing that a buyer is going to ask you is, why are you selling this business if it's so great? And you have to have an answer to why this business is a great business from that. So any comments on that before I go into some of the next ones?
No, I think everything you said there is very important. I mean, if you're giving them all negative and you're not achieving anything, it's not just gonna. Who wants to buy something like that?
Yeah. And so your story might be, I don't have to put a lot of work and I make a good amount of money. It might be I'm high growth, all of those things. But and don't just say, hey, this is obvious. Actually try and write it out. It's just like copywriting. Anybody says that copywriting is easy, it's like it's conceptually very easy. Yeah, write good copy. Have a benefit headline. You actually go try and do it, and I've tried to do it, and I'm not very good at it, and it sucks. It's really hard to do. As you know. And so it's the same thing here. Is you have to have that. Then what you need to look at is you have to work through what are the big four things that buyers value. And so the second specific action item is to grade yourself on what I call the 4 pillars of business valuations. And the 4 pillars go like this. First is profit percentage. Okay. Most buyers are looking, I call it the 20-20-20 rule. Most buyers are looking for 20% profit margins or more. And in this context, I'm using SDE, or seller's discretionary earnings. So you grade yourself on your profitability. And if you're south of 20%, you have to then take an action item to say, what's going to get me over 20%? And it's either going to be get the profits on your new products higher than the ones you have now, or it's going to be raise the profitability on your current products by either raising prices or lowering costs. But you eventually, when you want to go to exit, if you want a premium valuation, you should be at 20% or more. Otherwise, you're going to be at risk of a number of things, but losing a premium valuation is one of them. The second one is you need to plan on 20% annual growth or more. And that's a minimum. If you're only growing at 20%, the second pillar, that's considered flat. And the easiest way to think about it is most aggregators, their management bonuses and their excitement kicks in at 30% per year or better. So if you're only growing at 20% and they want to grow at 30%, you're dilutive unless they can increase the growth. So you should at least be growing at 20% or more. And then the third criteria that you've got is diversification. and no one product should have more than 20% of your particular revenue. Now, there are aggregators out there that will buy what we call the hero SKU companies. But if you're looking to be truly a diversified company and diversify the risk, so if I have 5 SKUs and they were all equally the same, that'd be 20, 20, 20, and 20. So if you really want to be truly diversified, you would have, a larger number of SKUs and not have any one SKU more than 20%. And then the fourth one is, once you have the big 3 down, the fourth one is just the size of the earnings does matter. And the larger your earnings, generally the larger multiple that you can obtain, as long as those other 3 are in place. So the second action item that I always say, and this is in the sheet, all the things that I'm telling you about are in this workbook, is that you can go to the tab. It's called lifetime business value or business analysis, and you go in there and you just say, where am I at against these criteria? Because if I don't know where I'm at with my buyer, criteria, I just have no idea if I'm even worthy of an exit. So that's the second specific action item, is to really dive into the big 4 and make sure that you understand where you rank on those. Any questions on that one?
Yeah, Simon just posted something. Was that 20% net profit?
Yes, 20% net profit. And generally, the way that I would describe that is that there's 2 ways that people calculate it, either EBITDA or seller's discretionary earnings. And seller's discretionary earnings is nothing more than an Amazon industry term for EBITDA plus owner add backs. So, your owner's salary, owner travel, because we have a lot of solopreneurs. But yes, 20% profit as defined by seller's discretionary earnings.
Okay. All right. That was great. And like Scott was saying, this is all in the book. One of the other things I was wondering, Scott, you were talking about at the beginning, knowing your numbers. And we talk about that quite a lot on the podcast. Do you offer, and I don't know this, but do you offer a course, or do you offer anything that people can learn more about understanding their numbers, or just how to read a financial statement?
Yeah, so we do offer that. If folks are interested in that, they should reach out to us. We'll give the website at the end.
Okay.
But the basics of it, that just to kind of highlight here on the podcast, is it's absolutely, and this is the third thing, is to feel confident that you have all of your numbers in an accrual basis, not a cash basis. And a lot of people struggle with that concept because they don't quite understand exactly all of the details of it. But it's just absolutely important for you to have your numbers on an accrual basis, because that's how buyers are going to do it. And there's a myth out there that if you have things on an accrual basis, you'll pay more in taxes. And it's absolutely a myth, because you have one set of books that you report. I'm a U.S. citizen. I'll report in the U.S. on a cash basis, but my financial books in QuickBooks or in Xero need to be on an accrual basis. So yes, we've got content that we have out there. We don't do a whole lot in what I'd call the paid course thing. So we'll more have tools and things like that for people that can help them on that side. We're actually just thinking about whether or not we should offer a paid a program for that. But we're kind of more industry stewards, and we've just wanted to get the content out there. So
Right.
people are struggling with that, just reach out to us and we can get you some information.
All right, perfect. Now, Simon came back with another question about the
Sure.
difference between seller's discretionary earnings and earnings.
Yeah. So earnings is a general term that can mean different things to different people. And earnings, oftentimes, if I'm using the acronym EBITDA, will mean earnings before interest costs on any loans, earnings before the T is taxes, and earnings before depreciation and amortization, which is not very much a factor in Amazon businesses. So if you're talking to a private equity company, earnings for them will almost always mean EBITDA, because they don't want to look at after-tax earnings, because your tax rate might be different than theirs. So they try and normalize it. And if I went from the top of the P&L to the bottom to show you what this is, Simon, revenue minus your Amazon fees and minus your product costs equals your gross profit. So that's your gross profit. Gross profit minus all of your marketing costs equals something called your contribution margin, because now I've got all of your variable costs accounted for. And then contribution margin less overhead equals your EBITDA, your EBITDA, and then EBITDA plus your add backs for owner related or one-time expenses equals seller's discretionary earnings. And in this context, for most people that are smaller companies, we $1 million and less in earnings, you'll want to use SDE. When you get over the $1 million in earnings mark, a lot of buyers buy based on what's called EBITDA, which is that line above that. And so that's what earnings is, kind of a general word that can either be describing EBITDA or seller's discretionary earnings. So it's important to break it down which one we're talking about, because they do differ.
All right. Very good. Okay, let's move on. Next pillar.
Yeah. So the next thing that I always say to people is that a buyer, when they're looking to the third action item, exciting story, analyze yourself against the four pillars of premium valuation. The third thing is a buyer is always asking three questions whenever they want to buy something. And they won't phrase it this way, but this is how the easiest way to think about it is: what is the seller asking me to believe? How bad do I have to believe it? And what if I don't believe it? Okay. And most people spend a lot of time getting everybody excited about the first two questions. I really want you to believe this is a great company, Norm. And I really want you to, you don't have to, believe it really bad. It's just doing great. It's going to continue to do great. Most buyers are wondering about which question? The third question. If I don't believe anything the seller says, and if everything goes bad, what's the worst that can happen? Right? Because if you think about it, like if you were going to buy my company, you wouldn't be asking how much money you can make. The first thing you're wondering about is, I don't want to lose any money. Right?
Right.
Okay. So what that means for you in a specific action item is that you need to get rid of all of the things that create buyer risk. And I'm going to give you an example of some of those. So black hat tactics that will get you shut down, patent infringements, lack of accurate accounting books, not having the right numbers, having very complicated business dealings, lack of clear ownership of your intellectual property. So there's a whole bunch of what I'll call risk items for a buyer. So the specific action item is to look at your business from the idea of mitigating risk. And the way I always describe it is, the best way to get a premium valuation isn't to show a buyer a great story that's really risky. It's to show them a good story that has virtually no risk in it whatsoever. So I know it's always a balance with Amazon, terms of service and all of those types of things. But the fact of the matter is that you need to create what's called a risk mitigation plan. It's not, again, I like to fit all of these on one page, but you need to list out today, from the buyer's lens, what are all of the things that are risky in your particular business? And then you need to take action steps toward eliminating those things from being in the business in the year before you exit. Because, for example, if you have all of your revenue tied up with one supplier, is that a risk? Yes. If that supplier doesn't stick around or raises prices, and you're reliant on that particular supplier, you have a risk in that particular business. Now, that doesn't mean go out and get 5 more suppliers, but it means if I have all of my eggs in one supplier basket, or 80% of it, then I need to get a contract with that supplier that guarantees me service levels. I need backup stock. I need different things, where if I have 5 different suppliers and I'm diversified, so I won't be able to give for every business, but whoever wins the half hour, I'm happy to walk it through with you. But the specific action item that you need to think about is, you need to understand what the risks are in the business, and you need to have a plan to mitigate those risks before you exit. Most people, what happens is they get so excited about the story, they go out to the aggregators, or usually what's happening now is the aggregators approach them and they go, yeah, I want to sell. And then all of a sudden they realize that they're not going to get a premium valuation, because there's a bunch of risks in the business that they need to get rid of. So, incentivized reviews, inserts, we've all seen the list, right? And you have to have a little runway ramp. You have to have where you've got a low risk business before you exit. So exciting story, analyze the 4 pillars, get rid of the risks in the business, is you're 60% of the way there of the 5 things that I wanted to talk about toward getting a premium valuation.
Okay. And yeah, one of the things I'll just add is don't lie.
Yes, absolutely. Yep. That kills a deal. Everything in due diligence is going to get found out. So the notion that buyers are not sophisticated. When I started in this 4 or 5 years ago, you could get away with games because the buyer might have never bought an Amazon company before. All of those different types of things, but it just doesn't happen today. So the fourth thing is forecasting. And what I would say to you is anybody who does not have a forecast for the next 2 years of your business, it's impossible for you to know when's the right time to exit. And most people will not do forecasting because A, it's hard. B, it changes all the time. And so C, why bother? And the answer is because it's hard and because it changes all the time. C is you have to do it and maintain it all the time because your inventory ordering relies on it. But more importantly, if your business is going like this and you start to notice that unless you put more cash in, it's going to start to taper off, you have to time your exit to get a premium valuation at when you're still in the high part of the growth curve. Because if I draw you this, Norm, if I draw it like this and it's going up and then it starts to level off, what's the next thing that you think that it's going to do?
Oh, it's going to drop.
It's going to go down, right? And so you have to have a forecast internally to know that. And what it's going to start to show you is that if you have 20 products and you want to grow at 50% a year, you got to add 20 more because 10 are going to fail, or whatever it happens to be. So a forecast is ultimately what really gets you along the road of knowing where on that curve am I, and be honest with yourself. For every one of the clients we work with, we not only develop a forecast, we develop a worst case scenario, a base case, and a best case, because we want you to understand the range of your outcomes, such that you know when's the right time to sell. So no forecasting means no ability to run your business. It's like driving blind, and it's no ability to know when is the right time to sell. So that's the fourth thing. And it doesn't have to be complicated. We do very advanced forecasting if people work with us, but even a simple forecast is better than none. Which gets to the last thing, which is the last specific action item that everybody should take once you've got those other four is once you understand where you're at today, the specific action is you need to define what is the definition of a successful exit for you. And for some people, it's I want to exit for $500,000. And for other people, it's I want to exit for $10 million. I'll never forget, I had somebody that came up to me and they said, Scott, we followed your system. I met you 3 years ago at Seller Conference when you were speaking. And I went home and I told my husband I was going to sell for $5 million. And we just started out and guess what he said? Imagine he was real supportive.
I think I know what he said.
Yeah, exactly. Right. And he said, and both of them were there. So the husband was there too.
Yeah.
And the wife came up to me and she said, I'm so glad to meet you. You gave me this blueprint. We followed this blueprint. It's 3 years later. We kept releasing products because we saw that was the lifeblood. We focused on our exit. We're at 1.1 million in earnings. And we now know because we have a forecast that we're worth over $5 million and we want you to help us exit. And it was a very simple system of all I did is I said to them, if you look at what the average profitability of a product is and you set a forecast that you're going to release this many successful products over the next 3 years, and if you take an average product that makes $20 a day and you sell 20 units and you make 20% margin and you can get to 20 products that are successful, you're going to be worth well over $500,000 on your way to 1.5 million. And they drew out the map in their industry and lo and behold, they got there. So the last one I kind of save the best for last because some people would argue that's the one you should do first. Back to the first thing I mentioned on the podcast. Before you get into business, know whether or not this business you're going to exit to just get $500,000 off the table, which is a lot of money in my house, and I don't want to live in a house when it's not. Or do you want this to be the $5 million exit? And if you don't know that going in, you might pick a niche. You don't need to be in supplements if you only want to exit for $200,000. The same token is if you're the best, seller of some little widget and you want to sell for 20 million bucks, you're not going to get there either. So
Right.
the last specific action item is to fill out. It's on the workbook. It's called the freedom chart, and it's what's my freedom exit number, and is this business going to get me all the way there, or is it only going to get me half there? But what's the dollar number that I'm trying to get out of my exit? And you got to plan that from day one. And it's a very simple action step to take, but it clarifies you then on what you need to do to reach your number.
Do you remember back in New York, we were talking about cash flow? We talk a lot about cash flow here. It's number one killer. If you don't have the proper cash flow, it'll kill you. It's a little bit off topic, but
Yep.
proper capital or proper cash flow. You gave me a story once, and I hope you remember it, about somebody that came to you and they had they were crippled with cash flow. You you gave them a suggestion just about breaking up the cash flow and how much that loosened up their cash. Do you remember that story?
Yes, I think I do. Yep. So yeah, I think of cash flow as the king on the chessboard. No king, no game.
Right.
So yep. And so the story I think that I told you was somebody had came to me. They wanted to exit their company for $800,000, and they were struggling. We worked on item number 4, which was their forecast, and it showed an incredible forecast. And so I went back and I said, I know the guy's not, his name's not Bill, but I'll use Bill. I said, Bill, something's not true here. Either you don't believe your forecast or you should not sell. And he said to me, I have to sell because in order to achieve that forecast, I have to go borrow a bunch more money and I don't want to go do that. And I said, well, then, Bill, it's not the right time to exit your company. It's the right time for us to work together to go get you the cash flow to grow the company. And so what we did is we built a plan. And in this instance, we went to their supplier, and we got the supplier to give us 150 days after shipping terms. So literally, they would buy it in August and didn't have to pay for it until March of the following year. That freed up the cash flow. We ordered 5 times as much inventory. We increased the profit from 200,000 to over $1 million, and then we exited the company the following summer for $5 million bucks. And it was all based on breaking out. And there's we actually have a whole bunch of different strategies that we work with people on. How do you free up cash flow? That one happened to be suppliers, but there's also taking on minority investors. There's taking on the one thing I don't like to do, interesting, is I don't want anybody to take on personally secured debt. I'm biased against it because I've got gray hair and I've seen too many of my friends and entrepreneurs, take out loans that were personally guaranteed. They might have had low interest rates, but when things didn't go well, now they're on the hook.
Yep.
And so we work on things that are not personally secured debt. But I think that was the story. And then and basically what he came to me was he thought he wanted to exit, but what he really just wanted was the cash flow to really grow the company to then exit. And we were able to help him get that done.
And I think what ended up happening was instead of going negative and selling the business like you were talking about there, he ended up loosening, I think it was $480,000 in cash flow.
Yes, yeah. In fact, by the time that we exited the company, he had built up. He'd got 480,000 in cash flow by the end of that holiday because it was a seasonal business. By the end of the next year, he had built up close to $1 million in cash in the company because he was always getting paid from Amazon before he was having to make his supplier payments. And so it created, and that became, interestingly enough, a part of that exciting story. Back to my specific action item number 1 was. I've got a seasonal business, but because I've got great cash flow, I can buy more inventory and outcompete all of my other competitors. And when you buy this business, you don't have to pay, you have to pay me, but you don't have to go borrow a bunch of other money, what's called working capital. And we've actually got in the workbook, it shows you how to calculate net working capital, but he had a positive net working capital to where he didn't need money. He actually had money coming in before he had to go pay his suppliers. So that can't happen with every business, but it was a very critical point. And we'd freed up close to $500,000 within 6 months. And then within another 6 months, we'd freed up even more. And that really drove the valuation up on that particular company, because you can imagine the buyers were, they were looking at that going, this is a pretty exciting story.
Yeah. Yeah. So look, I mentioned at the beginning that Scott's got some really incredible stories, But look, we're having this Wheel of Kelsey. If you're interested in the Wheel of Kelsey and getting the workbook, everybody gets the workbook. But having a 30-minute one-on-one with Scott is going to be incredibly valuable for you and your business. So just before we head over to the Wheel of Kelsey, just hashtag Wheel of Kelsey or Hayden and tag 2 people. You'll be entered. But by the time we come back, we'll head over there. Right now, Hayden, can you put your finger on the button? Sponsor, please do that. Meet Sellerize, our favorite suite of tools for Amazon sellers. Leverage 19 innovative tools to dominate your competition on Amazon. Get your customer reviews, rank higher, track and analyze profit in real time. Sellerize is what you need to make data-driven decisions and give your business a boost. Get a free month trial by signing up with a coupon, Beard Nation. Follow the link in this episode's description and get started now. Hey, Scott, if people wanted to get a hold of you, how do they do that?
Yeah, so I've been at this 6 years, and the one thing I would say is that my most important passion is helping entrepreneurs get the answers that they need, so that they are armed like the buyers are armed on the other side of things. So I'm always available. The way to reach me specifically would be Scott, SCOTT, at northboundgroup.com, and our website is the same. So if you want to go to our website, it's www.north, the word north, the word bound, the word group.com. So, and happy to answer any questions that come in. Sometimes people are private on this topic. So, if you're listening to this, just hit me up there, and, I'll be a resource to you, whatever I can do to help. It's truly a life's passion for me.
All right, great. And Hayden, make sure that you put the link in. I just saw that Simon's looking for the workbook. But again, anybody listening to the call, it gets that free workbook. So you'll put that in. Now, I don't know if people know this, but Hayden is the not only the producer for The People, but he's the person that wrote the music and the animation and everything for Wheel of Kelsey as well. So the other guy, just a family full of people who do weird things.
Bunch of weirdos.
Yeah, a bunch of weirdos or beardos. All right, let's head over to that Wheel of Kelsey.
It's time for the Wheel of
Oh, okay, doing your own thing, are you?
Yeah, just a little improvisation.
Okay, very good. All right, so let's do the wheel.
All right. So let's see. I got to share my screen,
Scott,
right?
that's typically not what happens. It's when my other son takes control like this.
I love it.
Okay, share screen.
Yes. Oh my God.
Can you see my screen?
Not yet. There we go. Okay.
All right. All right. 3, 2, 1.
There's no sound. Is it spinning?
Yep.
Okay. Who's the winner?
Michael Eastman is the winner.
Oh, fantastic. All right, Michael. So to get the giveaway, just email k@lunchwithnorm.com and we'll get you all the information to send that over. And once again, we've also, hey, Michael, if you're not a member of the Centurion League, I'm going to throw in a free Centurion League membership for the month. Okay. And I think that's it. Scott, you're off the hook.
All right, that sounds great. Thanks, everybody. And thanks, Norm. Always great rapping with you. Can't wait to see you next week. And maybe we'll get a little more listening in.
Absolutely. Okay. I'll see you later, Scott.
Yep. Bye-bye, everybody.
Bye. Okay. Join us next week or actually it'll be, Monday next week. Kitty Lay is going to be coming on and we're going to be talking about how bad design can affect your brand and sales. So I met Kitty years ago. I was doing a talk at the head in London at Amazon HQ and got to meet her there. And I recently met her and her partner on the Online Sellers cruise, and she blew me away. So asked her to come on the podcast right away, and hopefully everything goes okay when I'm in Vegas. Hayden, anything else?
No, that's it. Remember to smash those like buttons, follow the podcast, comment on Norm's beard whenever possible.
All right, very, very good. You're doing an absolute great job. Hopefully,
Thank you.
I'm just saying that, by the way. Hopefully, Kelsey, hold on, a virtual hug for Kelsey. Okay, we got to give him
Let's all virtually.
Yeah.
hug
Let's
him.
hope that he gets better soon. All right, everybody. Join us every Monday, Wednesday, and Friday. We will be at the Hayden, just a reminder to put that link in there if you could right away. But we will be at the Prosper Show. If you see Tim, myself, Kelsey, unfortunately won't be there, but make sure you come up, say hi, and thank you for being part of the community. We will see you next week. Have a great weekend. This is where you hit the music, Hayden.
2, 1.
Oh,
Uh-oh.
This is awkward.
Uh-oh.
This is awkward.
Uh-oh.
What? Oh, God.
Lunch with Norm.